in foreign currency. And that could be US dollars, euro, etc., etc. So in order to record them, we must convert the foreign currency amounts into equivalent Canadian dollars. To do that conversion, we use the spot rate on the date of the transaction. Use spot rate on the date of the transaction to record the transaction. Specific exclusions or exceptions to this might be when you're dealing with something like interest. So interest expense or interest income, you will use the average rate over the period. When you are converting depreciation, you will use the historical rate. Or when the asset was acquired. And if you have high volume of recurring transactions, such as, so example might be sale of crude oil via pipeline, right? So if you kind of think about that, an oil and gas company based in Canada sells to, say, buyers in the US, and they make the, basically ship it by pipeline. The pipeline is, is ever flowing. So on a very consistent basis, as your crude oil keeps flowing over to the buyer's stateside, you continue to earn sales revenue. And this is like it's an ongoing kind of transaction. It is possible for you to calculate the daily volumes transmitted and then compute your sales in equivalent Canadian, because for oil and gas companies, their sales prices are usually in US dollars. So it is possible for you to do it on a daily basis, but it might be a little bit overkill. So when you have high volume of recurring transactions such as that, you could end up using, in this case, you can use we may use average rates as long as the exchange rates do not fluctuate wildly. That is not really defined anywhere, so it will be a matter of professional judgment involved as to what constitutes a wild fluctuation in exchange rates. The Canadian dollar vis-a-vis the US dollar, if you look at its history, every day the exchange rates change. And if you look at the historical exchange rates, so Canadian dollar to US dollar, if we look at the graph here, over a 5-year period, you can see the rate has fluctuated considerably, right? It went to a low of 0.71, went up to 0.79, So it keeps changing, goes up to 0.8. If you go farther back, the lowest that the Canadian dollar has gone, I think, is has been in 67 cents, something like that. I think it went as it was projected to go as low as 60 cents US. And then I also remember around 2007, I think it was, when the Canadian dollar was in fact higher than the US dollar. The exchange rate was $1.04, $1.05 um, for one Canadian dollar relative to the US dollar. So exchange rates can change over time significantly, but as long as the pace of change is not too wild, so if you have, let's say the rate kind of stays between this zero point 0.7 to zero point 0.8 range, you can probably go with the average rates. All right. So I'm going to demonstrate that concept using this example. So it's a bunch of different transactions that we'll be working through. On Jan 1st, 2001, Signature Limited borrowed 200 million Japanese yen from Hitachi Bank of Japan at 5% per annum, with interest payable annually on January 1st. So if you think about how to account for this transaction, if you've borrowed money, then it's basically about debiting cash and crediting the bank loan. So the actual debits and credits are not difficult. Debit the cash, credit the bank loan. The only thing is that because the loan is in yen and Signature is a Canadian company, Signature cannot debit cash credit bank loan and type in 200 million, because the 200 million is in yen, and being a Canadian company, the monetary unit, the unit of accounting for them, is a Canadian dollar. So they have to convert the 200 million Japanese yen into equivalent Canadian dollars. To be able to do that, we need an exchange rate for the Canadian dollar versus the Japanese yen. So in here, you're provided with a bunch of exchange rates here. You've got exchange rate for Canadian dollar, Japanese yen, euro and a Canadian dollar and Pakistani rupees, and US dollar and Canadian dollar. So if you notice, for the Canadian dollar and the Japanese yen, the exchange rate is given in terms of 1 Canadian dollar equals how many yen? So 1 Canadian dollar equals 84.5 yen, right? So if you have 200,000 yen, to convert the 200,000 yen into equivalent Canadian dollars, because 1 Canadian dollar can buy 84.5 yen, the 200 million yen converted into Canadian dollars will be equal to 200 million divided by the 84.5, which was the exchange rate, by the way, on Jan 1st, 2001. So you'll divide the 200 million yen by the exchange rate, 84.5, to get the equivalent Canadian dollars, which is 2,366,864. This way of presenting the exchange rates is called an indirect quotation, where the value of the foreign currency is not expressed in Canadian dollars, but rather the Canadian dollars are expressed in terms of the foreign currency. When you have that kind of an exchange given, then you do division, right? You will divide by the exchange rate. So 200 million yen borrowed is equal to or equivalent to this much, 2,366,864 in Canadian dollars. Is that okay? Now, The next transaction to occur is on March 1st, 2001. Signature purchased inventory from a company in Germany for 150,000 euros with payment to be made on July 1st, 2001. So March 1st, the euro Canadian dollar exchange rate is 1.456. Now here, the exchange rate is for 1 euro equals how many Canadian? So 1 euro can buy 1.456 Canadian. 150,000 euros will be worth 1.456 times 150,000. So this is actually called a direct quotation. Okay, I talked about that in the lecture video. The Japanese yen quotation was 1 Canadian dollar equals how many yen? Whereas for the euro, it's 1 euro equals how many Canadian dollars? So depending on how your exchange rate information is available, you will either divide or multiply the foreign currency by the exchange rate. So converting from euros to Canadian dollars, 150,000 euros will be 150,000 times the 1.456, 218,400. And of course, if you've bought the inventory, you debit inventory and credit the accounts payable. Notice that in order for us to remember that these are balances that are actually denominated in a foreign currency, I just put the within brackets the name of the currency. So this bank loan payable is actually in Japanese yen, right? The accounts payable is actually in euros. So when we make payment, we'll have to pay the supplier from Germany in euros, right? We don't necessarily end up paying these many Canadian dollars because we have to pay them in euros. And depending on changes in exchange rate, we may end up paying more Canadian dollars or fewer Canadian dollars. And that is what drives the foreign exchange gains or losses. Okay. Next, so keep in mind the payment on this inventory purchase will be made on July 1st. Now, next one, on April 15th, 2001, Signature received an order from Pakhtun Trading of Pakistan for goods worth 20 million Pakistani rupees with payments due on delivery. The goods were delivered at Karachi port on August 31st, 2001, and payment was received by wire transfer. So when you have something like this being structured, you have to look into when the risks and rewards in the inventory are transferred, because that's when you record sales. You record your revenue when the performance obligation is completed. So when you see the information here, goods have to be delivered and then the payment will be sent out. It seems like it is a an FOB destination transaction. I'm seeing in the chat box, there's a question. For the first example, could you do an interest payment Jan 1st, year 2? So we are getting there, Hugo. I'm just going by the chronological order. So we'll talk about the interest later. So coming back to that April 15th, because it doesn't appear that the performance obligation, the risks and rewards and the goods are not transferring until the goods are delivered, you will not record any transaction or not record any entry whatsoever on April 15th. You'll wait for August 31st. Next, on July 1st, 2001, Signature purchased the operating assets of Nevada Corp for $5 million US. purchase price was allocated to land 35%, building 45%, and the rest to equipment. So you're buying land, building, and equipment. So the journal entry itself should not be too complicated. Debit the land, debit the building, debit the equipment, and there was no indication as to how it was being settled. So I'm thinking maybe cash was paid. Now we paid $5 million in US currency. So $5 million US is not the same thing as 5 million Canadian dollars. So this transaction took place on 1st of July. The exchange rate was 1 US dollar equals 1.32 Canadian, right? So 1 US dollar could buy more Canadian dollars. So 5 million US dollars in equivalent Canadian dollar terms will have been 5 million multiplied by the 1.32, $6.6 million. This amount was allocated 35% to the land, 45% to the building, and the remainder to the equipment. So of the 6.6 million, you calculate 35%, and that's the amount to debit to the land. Calculate 45%, and that's the amount to allocate to the building, and the rest will go to the equipment. All right. So now remember that we also needed to make a payment to our supplier from Germany, Swan Company. 150,000 euros have to be paid on July 1st. So we need to pay 150,000 euros. So we have an accounts payable in euros that has a carrying amount of 218,400. So we need to make payment on these accounts payable. Now, when we pay, we are required to pay in euros, and the amount in euros is 150,000. We will need to purchase the euros, or maybe basically, we'll ask for the bank to make a wire transfer, but we need to get the equivalent euros. Now, what happens is that on July 1st, 2001, the exchange rate for the euros has changed to 1.462. 1 euro used to be 1.456. Now it's 1.462. So when we buy the euros, the 150,000 euros, we have to use the spot rate for the date that we are making the payment. And so when we make the payment, the actual cash in Canadian dollars that we have to shell out is 150,000 times the 1.462, or $219,300. So this is interesting. When we purchased the inventory, the euro exchange rate had been 1.456. Now, when we're making the payment, the euro exchange rate has changed to 1.462. Yeah. So you'll be settling the accounts payable that you recorded initially at $218,400. The actual cost to you to make that payment in euros, 150,000 euros, in equivalent Canadian dollars is 219,300. So you ended up having to pay more to settle that accounts payable. If you had to pay more to settle a liability, the difference of $900 between the two is recorded as an FX loss. It's a foreign exchange loss. We use an account that can be used both ways, FX gain or loss, depending on the balance, the final balance at the end of the year. If you have a debit balance in the account, it would be an overall loss. If you have a credit balance in that account, it would be an overall gain. right? So this here is an FX loss, right? On the accounts payable, this difference, you settled an accounts payable liability of 218,400 and you had to pay 219,300. You had to pay more to settle. The difference represents a loss for us, and that loss is because of changes in the foreign exchange rates, right? So that's the FX loss for us here. Okay. Are we good here? Not good? If it is crystal clear. Signature decided to use the revaluation model for land. On December 31st, 2001, the land that was acquired from Nevada Corp was valued at 1.8 million US dollars. Now, the revaluation model is something that you folks learned about in your first intermediate course. Of course, when you're in an advanced accounting course, you have to remember stuff from earlier courses. So this is just a gentle uh, reminder. So here they decided to use the revaluation model. So the land we had originally recorded at 2,310,000 Canadian dollars, and that was basically 35% of the 5 million US dollars, right? That's how much the US dollar conversion would have been, and then multiplied by the rate of 1.32, we got 2,310,000 in Canadian dollars. Now, on December 31st, the land is valued at 1.8 million US dollars. Now, that 1.8 million US dollars in equivalent Canadian, when you're doing the conversion on December 31st, the equivalent Canadian dollar rate is 1.33. 1 US dollar is equal to 1.33 Canadian as of December 31st, 2001. So the land, which in US dollars has been valued at 1.8 million, of course, we can't show that on our balance sheet at 1.8 million because that's 1.8 million US dollars. So to express that into equivalent Canadian, you got to use the exchange rate of 1.33, which is the exchange rate on December 31st, 2001. And so you multiply 1.8 million by the 1.33 exchange rate, you get $2,394,000. So the land will be reported on the balance sheet of this company, Signature Limited's balance sheet, at 2,394,000 Canadian dollars, because that's how many Canadian dollars 1.8 million US dollars is worth. Now, originally the land had been recorded at 2,310,000. When you look at the 2,394,000, you can clearly see that there's been an increase in the value of the land to the tune of $84,000. The increase in the value of the land, in order to show that on the books, you need to debit the land for $84,000. And if you guys remember your revaluation model, if the companies use the revaluation model, then any increase in the asset value is reported through other comprehensive income, right? So you will credit other comprehensive income, the revaluation surplus. Okay. December 31st is also the year end for this company. So you have to think about the adjusting entries. So hopefully you'll remember that the building and the equipment that we had bought from Nevada Corp are, they have limited lives. The building had an estimated useful life of 10 years. The equipment had an estimated useful life of 4 years. We need to depreciate the building and the equipment. And also keep in mind that since we made the purchase on July 1st, 2001, we will only be recording a half year's worth of depreciation for the year that ends December 31st. From July 1st to December 31st is 6 months, half a year. Now you're recording depreciation. The journal entry for depreciation is debit depreciation expense, credit accumulated depreciation. So you can show this in two separate journal entries, or you can just make one journal entry. You debit the depreciation expense and then credit the accumulated depreciation on the building and credit the accumulated depreciation on the equipment. Credit the accumulated depreciation on the building. So the cost of the building was $2,970,000. This is to be spread over 10 years because that's the estimated life of the building. So 2,970,000 divided by 10 gives us 1 year's worth of depreciation. And then adjust for a half year, right? Because you're only taking a half year depreciation for 2001. So that will give us accumulated depreciation on the building for this year being 148,500. Likewise, for the equipment cost is 1,320,000. The equipment, we're told, had a useful life of 4 years. So 1,320,000, if you were to divide that by 4, you get the annual amount of the depreciation, and then adjusted, prorated for the half year, we get the depreciation on the equipment is 165,000. So basically, this is the 1,320,000 divided by 4 and then prorated for the 6 months. The combined amount, 148,500 and the 165,000 is the total depreciation expense. This we could very well have shown as two separate journal entries. So depreciation is always calculated on historical cost. That's what I mentioned up here. When you're calculating depreciation, you will basically be using the historical rate, which means just use the original cost that you recorded the asset at. This is the cost amount that we recorded the asset at. That's the cost that should be depreciated. Okay, so if that is done, then you have to remember we had borrowed money from the Japanese bank at 5%. Interest is payable January 1st. So the first time interest will be paid will be Jan 1st, 2002. However, you folks would not have made it thus far in accounting without knowing that, well, if time has passed, then we need to accrue for the interest expense, right? So we borrowed the amount on Jan 1st, 2001, even though we will actually be paying the interest on the loan on Jan 1st, 2002, on December 31st, 2001, because December 31st, 2001 is the year end, we have to accrue the interest expense. And of course, you don't need to pull out your calculators, or maybe you do. 200 million, 5%. You can do the calculation, give you 10 million yen. That's how much you will need to pay for interest on Jan 1st, 2002. So you're not actually paying the amount on December 31st, 2001, but you must accrue for the interest. When you accrue the interest, you know the journal entry is debit interest expense and credit interest payable. The Japanese yen amount is 10 million Japanese yen, because your bank loan is 200 million yen. Interest rate is 5%. 5% of 200 million gives you 10 million Japanese yen. So you got to record the interest. So you will debit the interest expense, credit the interest payable. Now, 10 million yen is the amount of interest expense. You have to convert the 10 million yen into equivalent Canadian dollars. Now, when you're calculating the interest expense, or it could have been interest income as well, if the company had lent money in foreign currency, and we could have been recording interest income as well. Either way, when you're recording interest expense or income for the statement of comprehensive income, you want to use the average rate for that time period. So if we are recording interest expense for the year, so if we are doing that, we want to use the average rate for the year. So when you look at the Japanese yen information, the average for 2001 is 85.9. That was the average rate of the exchange rate for the Japanese yen for the year. So you got to use the average rate for the expense. 10 million yen, you will divide by the 85.9, the average rate, and that gives you 116,414, 116,414 Canadian dollars. Now, I didn't type it in here. For the balance sheet, any monetary items have to be translated using the closing rate. Closing rate is the spot rate at the end of the year. What monetary items are, I've explained in the lecture video. In a nutshell, monetary items include cash and other liquid assets such as accounts receivable, any kinds of notes receivable, so on. It does not include inventory because inventory has to be sold first before you can make collection on it. So the word monetary involves something that is either cash or can be converted into cash or has to be paid for in cash at a known amount. And the amount does not change a lot. So as far as assets go, you have cash, accounts receivable, notes receivable, those kinds of things. All liabilities that are payable are monetary. So accounts payable, notes payable, bonds payable, any kind of liability is a monetary liability. So here, we're crediting interest payable. Now the interest payable is 10 million yen. But because December 31st happens to be the year end, we have to convert the 10 million yen using the closing rate on December 31st. So closing rate for the Japanese yen was 87.2. Right? Closing rate is 87.2. So 87.2, when you divide 10 million Japanese yen by the 87.2, that gives us 114,679. So Joseph, those were just, you don't have all of the exchange rates. The exchange rates that you have are for select dates. So you can't just calculate a simple average of these. When we talk about an average rate is like an overall like daily average. So that is calculated for all the rates, like all the daily rates. And so you just basically have to go with what's provided. Is, bottom line, try not to sit down and start calculating. Just go with what is given. Yeah. So when you divide by the 87.2, you get interest payable 114,679. The expense was converted using an average rate, and the payable is translated using the closing rate. Now, there is a difference between these two amounts. The difference is a credit of 1,736. That credit difference is basically nothing but an FX gain. We ended up with a foreign exchange gain here, given the fact that the Japanese yen suddenly lost value against the Canadian dollar. The Canadian dollar appreciated relative to the Japanese yen, and that resulted in our liability reducing. So the equivalent Canadian dollars for the liability went down, we benefited. Is that okay? All right. So if that's that, then we have to remember that the bank loan payable, the 200 million bank loan payable, well, guess what? That's a monetary liability as well. So when we borrowed the amount, the exchange rate had been 84.5. So our liability is currently sitting at 2,366,864. The liability is not changed. It's still 200 million Japanese yen. But given the fact that the closing rate is 87.2, we have to convert the 200 million yen using the 87.2 rate. So if you divide 200 million by 87.2, the liability in equivalent Canadian dollars is now only 2,293,578. Liability is smaller. So if our liability has gone down, you want to debit the liability by the difference, $73,286. So debit the bank loan payable, $73,286, and credit FX gain. So if you think about what's the net total FX for the year for this company, Well, they had an FX loss of $900, and they had an FX gain of 1,736, and an FX gain of 73,286. So the total FX gain for 2001 is basically $73,286 plus $1,736 minus the loss of $900. So that's 74,121. All right, so that was a sweet little example of foreign currency transactions. Uh, the transactions, the debits and credits are not challenging. They're fairly straightforward. So on Connect, you guys, I think, have an example that you will be working on for this particular topic. Transactions themselves are straightforward. You just have to keep a few things in mind, that for you use spot rates for transactions. Just keep in mind that the exceptions are for depreciation. Basically use the translated amount of the original translated amount of the asset. So what I wanted to communicate here was, if you kind of think about the US dollars, right? So we paid 5 million US. You could have basically calculated the US dollar equivalent for the land, 35%, for the building, 45%, and then the difference for the equipment. And then we could have calculated the depreciation. So the building, 10 years, half a year. The equivalent Canadian dollars is 115, 112, sorry, not the equivalent Canadian, but in US dollars, the depreciation would be 112,500. On the equipment, the depreciation would be 125,000. Now, you don't want to use any other rate except for the original rate when the asset was acquired. So when the asset was acquired, the rate had been 1.32. So you want to use the 1.32 rate, right? So this is 148,500, 165,000. Well, that's what we've recorded for the depreciation. And we didn't have to calculate the amounts in US dollars or any of that sort, because all we did was we used the Canadian dollar cost and just went ahead and allocated that. Does that make sense? And then the other bit is the income, the interest expense or income, as the case might be. Be very careful with that. You have to make sure to use the average rate. And we did miss our friend Pakhtun Trading from Pakistan. We just happened to forget that the goods were delivered at Karachi port on August 31st, 2001, and payment was received by wire transfer. So August 31st, the exchange rate for Pakistani rupees was 96.5. 1 Canadian dollar equals 96.5 Pakistani rupees. So 20 million Pakistani rupees was the sales amount agreed upon. So we would get cash and we'd record a credit to sales revenue, right? So you sold goods, you're getting payment, debit, cash, credit, sales revenue. The sales revenue is 20 million Pakistani rupees. In equivalent Canadian, that works out to 20 million divided by 96.5, and that is 207,254. So our sales in Canadian dollars is a little over 207,000. We don't have information to record the cost of goods sold, but of course, you guys know that as accountants, we would also book cost of goods sold for this. There was not enough information given to us to be able to calculate that. All right, so that's all I had for topic 15, foreign currency transactions. It's almost 10 after 7.